Here is something nobody in the finance world wants to admit. The most effective money strategy on earth is also the most boring one. No hot stock tips, no secret investment formulas, no overnight wins, no exciting pivots, just quiet, steady, repetitive, boring. And while millions of people are scrolling financial news looking for the next big thing, a completely unremarkable group of people are doing the same dull things with their money every single month. And they are getting extraordinarily rich. Today, I'm going to show you exactly what those boring things are, why they work so well, and how you can start doing them yourself, starting this week. No matter what you earn, stay with me. Because the fifth boring habit is the one most people never start, and it is the one that does the most work. Welcome to Money Explained in Minutes, where complicated money becomes simple truth in under 25 minutes. By the end of today, you will understand why boring is the most powerful word in personal finance. Let us get into it. Here is a statistic that puts this in perspective. Research consistently shows that the average actively managed investment fund, run by highly paid professional traders making exciting decisions every day, underperforms a simple, boring index fund roughly 80 to 90% of the time over a 10-year period. Not some of the time, not half the time, 80 to 90% of the time. The excitement industry, the financial media, the trading platforms, the hot tip newsletters makes billions of dollars every year from people who believe that doing more exciting things with money produces better results. It almost never does. The reason is simple. Excitement in money leads to action, and action in investing, unless it is the boring, consistent kind, almost always costs you more than it earns. Buying when things look exciting, selling when things feel scary, chasing the new trend, moving money around, watching markets daily. All of these feel productive. All of these feel like you are doing something with your wealth, and almost all of them quietly destroy it. That is not your fault. You were never taught that the correct answer in personal finance is almost always to do less, not more, to be consistent, not clever, to be boring, not brilliant. But today you will see exactly why, and it will change how you think about money forever. The first boring habit sounds almost too simple to work. Every single month on the same day, the same amount of money moves from your account into your investment. Rain or shine, market up or market down, economy good or bad, news positive or negative, the same amount, the same day, every month. No decisions, no analysis, no timing, no waiting for the right moment. This strategy has a name: dollar cost averaging, and it is one of the most powerful and most boring investing approaches ever discovered. Here is why it works so brilliantly. When markets are high, your fixed monthly amount buys fewer investment units. When markets are low, your fixed monthly amount buys more units at a discount. Over time, this averaging effect means you are never buying entirely at the peak and never selling in a panic at the bottom. You are simply accumulating month after month, quietly, consistently, boringly. Think about what most people do instead. They wait for the market to look safe before investing. They invest more when everything is going up and feels exciting. They stop or withdraw when markets fall and feel scary. The result? They consistently buy high and sell low. The exact opposite of what builds wealth. The boring investor does the opposite without even thinking about it. They invest the same amount every month regardless of what the market is doing, and over 10, 20, 30 years, the results are staggering. Warren Buffett, arguably the most successful investor of the 20th century, has said multiple times that most people would be better off simply investing a fixed amount in a low-cost index fund every month and never checking it again. That advice is so boring that most people ignore it, and that is precisely why it works. Research from Vanguard, one of the largest investment managers in the world, consistently shows that investors who make fewer decisions and trade less frequently almost always outperform those who are actively managing and rebalancing their portfolios. The winning strategy is the one that requires the least exciting action. If you are not already doing this, here is what it looks like in practice. Pick an amount, even $50, even $20. Set up an automatic monthly transfer to an investment account on the day your income arrives. Choose a broad, diversified fund and leave it alone. That is it. That is the entire boring habit, and over 20 years it will likely produce more wealth than almost any exciting financial decision you ever make. And if $50 sounds out of reach right now, start with whatever you have. The amount is not what makes this powerful. The consistency is what makes this powerful, not the amount. The second boring habit is one that goes completely against every instinct modern technology has trained into us. Stop checking your investment portfolio, not weekly, not daily, certainly not multiple times a day. For most long-term investors, checking once a quarter is more than enough. Some of the most successful long-term investors check their portfolio once a year. This sounds irresponsible. It feels wrong. How can you manage something you are not watching? Here is the truth. For long-term investments, watching constantly does not improve performance. It destroys it. There is a famous study from Fidelity Investments, one of the largest financial services companies in the world, that looked at which of their customer accounts performed best over time. The result was extraordinary. The best performing accounts were either those belonging to people who had forgotten they had an investment account, or those belonging to people who had died. The investors who did nothing, literally nothing, outperformed the investors who were actively engaged. Why? Because every time you check your portfolio and see it down, every human brain triggers an emotional response. Loss aversion, the psychological tendency we explored in our previous videos, makes that drop feel twice as painful as the equivalent gain feels good. And pain triggers action. Selling, moving money, trying to stop the bleeding. Each of those actions has a cost. Transaction fees, missed recovery, tax events, poor timing. And then the market recovers, as it historically always has over long periods, and the person who checked and acted has missed part of the recovery, while the person who never looked has captured all of it. This is not a theory. This pattern has been documented consistently across decades of investor behavior research. Think about the last time you checked something, an app, a number, a metric, and felt the urge to do something because of what you saw. Most of the time, that urge to act is driven by emotion, not logic. Financial markets are designed to trigger that emotion constantly. Every red number, every scary headline, every expert predicting a crash, all of it is designed, consciously or not, to keep you engaged. Because engagement drives trading, and trading generates fees. The boring investor understands this, and they simply do not look. If you have a long-term investment, something you will not touch for 5, 10, or 20 years, the single most powerful thing you can do right now is close the app and stop watching. Your money does not need you to watch it grow. It just needs time. The third boring habit is the one most people think they are doing, but almost nobody actually does. Living below your means. Not at your means, not right at the edge of your means. Below them, deliberately and consistently. This does not mean deprivation. It does not mean never enjoying your money. It means structuring your life so that your monthly expenses are intentionally and permanently lower than your monthly income. and keeping that gap wide enough that you are always generating surplus. That surplus is not leftover money. It is the raw material of wealth. Here is the paradox most people miss. As income grows, as we explored in the Lifestyle Creep video, most people expand their lifestyle to match or exceed their new income. The gap closes. Sometimes it disappears entirely, sometimes they spend more than they earn. The boring wealthy person does the opposite. As their income grows, their lifestyle grows only partially. The gap widens. More surplus, more investing, more compounding. Over 20 years, the person who kept a consistent 20% gap between income and expenses, regardless of what their income was, will almost always end up wealthier than the person who earned twice as much but spent it all. This is sometimes called the frugality paradox. The people who look the least wealthy, modest car, ordinary house, no designer labels, are often the ones with the most actual wealth, because they live below their means and invest the difference. The Millionaire Next Door, one of the most comprehensive studies ever done on actual millionaires in the United States, found that the majority of millionaires lived in ordinary houses, drove modest cars, and spent significantly less than they earned. They did not look rich. They were rich. The people who looked rich, the ones with the luxury cars and the impressive houses and the expensive holidays, were often one paycheck away from financial difficulty. Appearances and actual wealth are frequently the opposite of each other. Living below your means requires two things. First, knowing exactly what your means are. Second, making a deliberate decision not to spend all of them. A simple rule that many boring wealthy people use is this: every time income increases, let only half of that increase go to lifestyle. Put the other half directly into investments. Your lifestyle still improves, but your wealth grows faster than your spending. This is not glamorous. There is no exciting moment, no celebration, just a quiet, consistent gap between what comes in and what goes out. Month after month after month, building wealth no one can see until it is extraordinary. The fourth boring habit will feel deeply uncomfortable for anyone who follows financial media. Stop watching financial news, not reduce it. Stop it. This is not about being uninformed. It is about understanding what financial news is actually designed to do, and why engaging with it almost always makes your financial decisions worse. Here is what the research shows. A study published in the Journal of Finance found that individual investors who consumed more financial media made more frequent trading decisions, and those decisions consistently underperformed investors who consumed less media. Financial news is not designed to make you wealthy. It is designed to keep you watching, and to keep you watching, it needs to keep you emotionally engaged. That means fear when things are falling, excitement when things are rising, urgency always. Every banner scrolling across the bottom of a financial news channel is designed to create the feeling that something important is happening right now and you need to act. Almost nothing that happens in financial markets in any given week is relevant to a long-term investor. Almost nothing. Whether the market is up 2% or down 3% this week does not change the fundamental fact that a diversified long-term portfolio has historically grown at 7 to 10% annually over decades. The noise is just noise. But here is the dangerous part. Noise that reaches your emotions becomes signal in your brain. It feels like important information. It feels like you should respond. And responding, as we have covered, almost always costs more than staying still. Think about the last time a scary financial headline made you feel anxious about money. Did that anxiety lead to a better financial decision? Or did it lead to worry, distraction, or a reactive choice you later questioned? The boring investor has a simple filter. If the news does not change their long-term plan, they do not need to know it. And almost nothing ever changes a sound, long-term plan. This does not mean being completely uninformed. It means consuming financial information intentionally, perhaps reading one quality summary per month rather than daily headlines, and never allowing short-term noise to influence long-term decisions. The amount of money saved by simply ignoring financial media and staying the course during every market panic of the last 30 years is extraordinary. Every person who sold during the 2008 financial crisis, driven by fear, amplified by media, and did not get back in missed one of the greatest market recoveries in history. The boring people who turned off the news and did nothing came out dramatically ahead. The fifth and final boring habit is the one that makes all the others effortless. Automate everything. Your investment contributions, your savings, your bill payments, your debt repayments. Everything that can be automated should be automated. This is not a new idea, but the depth to which most people apply it is far less than it should be. Here is why automation is so powerful in personal finance. Every financial decision you make manually, every time you consciously choose to transfer money to savings or make an investment contribution, uses willpower. And willpower is a limited resource. It runs out. It is affected by stress, tiredness, distraction, and competing priorities. Automation removes willpower from the equation entirely. A person who has automated their monthly investment contribution will invest every single month for 40 years without using a single unit of willpower. They will invest during months when money is tight. They will invest during months when they are stressed. They will invest during months when they completely forget about their finances, because the system does it, not them. The non-automated person will invest enthusiastically for 3 months, then miss 1 month because something came up, then feel guilty and skip another, then restart with good intentions, then miss again. Over 40 years, the automated person invests 40 times a year every year, 480 contributions. The non-automated person, even with the best intentions, might manage 300, 180 missed contributions, each one lost, not just in its face value, but in all the compound growth it would have generated over the remaining years. Automation is not lazy. Automation is smart. It is the recognition that consistent, boring action produces better results than inconsistent, motivated action. Here is what full financial automation looks like in practice. Payday arrives before you see the money. A fixed percentage moves automatically to investments. A fixed amount moves to your emergency fund until it is full. All regular bills are on direct debit. Debt repayments go out automatically on the same day. By the time you see your remaining balance, your financial future is already being funded. Whatever is left is yours to spend without guilt and without tracking every cent. This is sometimes called paying yourself first on autopilot. And it is the single structural habit that makes all the other boring habits sustainable over decades, because sustainability is the secret ingredient in boring wealth. Anyone can save for a month, anyone can invest for a year. The people who build extraordinary wealth are those who do it consistently for decades. And automation is how you make decades of consistency effortless. Start today. Log into your banking app after this video, set up one automatic transfer, even a small one, to move on your next payday. That single action, taking less than 10 minutes, will do more for your long-term financial health than almost anything else you could do today. Here is the hidden truth that connects all 5 of these boring habits. None of them are intellectually difficult. You do not need a finance degree to invest consistently every month. You do not need special knowledge to stop checking your portfolio. You do not need exceptional intelligence to live below your means. These habits are boring precisely because they are simple. And they are powerful precisely because most people cannot sustain simple for long enough. The financial industry profits from complexity, from the feeling that managing money is difficult and requires constant sophisticated intervention, from the belief that more action, more trading, more switching, more optimizing produces better results. It almost never does. And deep down, the industry knows this. The boring investor has seen through this. They understand that their greatest advantage is not intelligence or information or timing. It is patience and consistency, and the willingness to keep doing the same dull thing month after month while everyone around them is chasing excitement. Here is something worth sitting with for a moment. The most exciting financial stories you hear, the overnight millionaires, the hot stocks, the incredible returns, are survivorship bias. You hear about the rare person who got it right. You do not hear about the thousands who tried the same exciting strategy and lost everything. The boring strategy has no survivorship bias because boring does not fail. Consistent long-term investing in diversified assets has never, over any 30-year period in modern financial history, produced a negative return. Never. Not once. Excitement cannot say that. Boring can. That is not your fault for not knowing this. You were surrounded by a world that celebrated financial excitement and ignored financial consistency. But now you know, and that changes what you will do next. Here is your 5-step boring action plan. This week, 0 cost, any income, any country. Step 1. Set up your automatic monthly investment today, even $20, even $50. Log into your banking app after this video and create one automatic transfer that moves on payday. Do not wait until you have more to invest. Start with what you have. The habit matters more than the amount. This step takes 10 minutes. It costs nothing extra, and it is the single most impactful boring action you will ever take. Step 2. Delete or mute your investment portfolio app. If you have an investment account, remove the app from your home screen. Move it somewhere you will not automatically see it. Check it no more than once a month, ideally once a quarter. Let it grow without your interference. Step 3. Calculate your means gap. Look at your monthly income and your monthly expenses right now. Calculate the gap. How much surplus do you generate each month? If the gap is 0 or negative, that is your first target to fix. If it is positive, decide right now what percentage of any future raise will go to investments rather than lifestyle. Step 4. Choose one financial news source and limit it to once a week. Cancel or mute all daily financial news notifications. Choose one trusted weekly summary of financial news. Read it once, then ignore everything else. Notice how much calmer your relationship with money becomes within 2 weeks. Step 5. Write down your boring financial plan in one sentence. Something like, I invest X amount automatically every month into a diversified fund, and I do not touch it for 20 years. That sentence is your entire plan. Any financial news or exciting opportunity that conflicts with that sentence is not for you. 5 boring steps. All completely free, all completely actionable today. The foundation of every quietly wealthy person you have ever admired begins exactly here. Let us bring it all together. Boring habit 1. Invest the same amount every month regardless of conditions. Let dollar cost averaging work for you automatically. Boring habit 2. Stop checking your portfolio. The investors who do nothing consistently outperform those who do something. Boring habit 3. Live below your means deliberately and permanently. The gap between income and spending is the raw material of wealth. Boring habit 4. Ignore financial news. It is designed to create emotion, and emotion creates expensive decisions. Boring habit 5. Automate everything. Remove willpower from the equation. Let the system build your wealth while you live your life. 5 habits. All boring, all simple, all proven, and all completely ignored by the majority of people chasing exciting shortcuts that almost never work. You now understand something that takes most people decades of painful trial and error to discover. Boring wins, consistently, every time, over the long run. The moment this video ends, do one thing, just one. Set up that automatic transfer, even $20, because the person who starts boring today will be extraordinarily comfortable tomorrow. If this gave you value, subscribe to Money Explained in Minutes. Every week, one important money concept made as simple as possible. No jargon, no lectures, just clarity. And next week, we are going deeper. We are going to talk about why most people get stuck with credit card debt and the exact system to break free from it permanently. Subscribe so you do not miss it. Drop a comment below. What is the most boring money habit you already do? I read every single one. Money Explained in Minutes. Understand money. See you next week. Build wealth.